It seems that we don't know where markets are going. Of course, the JSE All Share oscillating on that flat line, but we've seen quite strong gains coming through for the local currency. It seems that we're seeing dollar weakness across the board and the euro gaining ground as well.
Yes, I think so. I think that strong rand is also pushing our resources down slightly. A lot of the market expecting that interest rate cut yesterday, and then expecting maybe the local resource stocks to move up with that, with a weaker rand. That hasn't happened, so people come in for profit taking, so pushing the resources down. And then even though we got a weaker dollar, that rand is very strong, and it just shows you that a 50 basis point move is not enough to diminish that carry trade, and people are still happy to get the yield onto the African bonds at the moment.
Well, looking at the volumes on the JSE today, last we checked around 2 billion rand passing through. Why are we seeing such light volumes? And we know that it's Eid today, of course, and it's also a Jewish holiday. Does that have anything to do with it?
I think some of the holidays do make a difference. I think one of the things is that right at the bottom of this range, you start to see a lot of volume come into the market as people start to buy at the bottom of the range. And then as we get slightly higher to the top, that buying starts to fade out. There's not enough momentum to push us through to the top of that range of like 26,000. So the momentum starts to die out, and so volume starts to die out with that. And then we stay in a lull for a bit and move back down to the bottom of the level again. So just momentum dying out at these higher levels.
We're pretty much range bound when it comes to the JSE All Share for some time now, that 10% range. Do you think we're going to breach that level going forward? I mean, it seems that there's still a lot of risks on the horizon, the banking sector in the European Union being one of the issues, and of course we're still looking to the US to get some proper economic data that is really going to point to the fact that unemployment is going to start coming down.
Yes, I think to push us out of the top of the range, we would obviously need unemployment in the US to come down quite dramatically, and we need sovereign debt issues to start to die out from the European side. If both of those work at the same time, we've got a chance to break out of the top of the range. On the bottom of the range, any sovereign debt problems are going to push us right down to that bottom. But I think people do feel that a sovereign debt issue, a sovereign debt, and one of the countries going under is not as likely as before. So you always see that buying come up to the bottom. I think the risk is that the economies do start to turn around and we break the top of the range. So I think the risk actually lies on the market bouncing above that 26,000. But we're going to need a few concurrent economic factors to be all working together to push us through that top of that range.
Well, that said, Rob, I mean, looking at it from a trader's perspective, I mean, and the fact that you're sitting on the desk, what are you doing at this point in time? I'm sure it must be quite difficult to read the markets, and it seems that most investors for now are looking just for some good news to give them an excuse to get into the markets. Do you think that is going to switch very quickly, and perhaps we'll see some negative sentiment early next week?
Well, on a trading side, it's slightly easier than on an investing side. When you're trading a range, it is a bit difficult to buy it at the bottom, but you generally get a small movement where you can make money. On an investing side, and where the big funds have to invest, it's much more difficult trading in a tight range. When do you invest all of that money into the markets for a much longer term view? And you could be stuck with stocks that don't move for over a very long time. So slightly different on the trading side compared to the investment side. But the people are coming into the market at the lower ends, and I think that buying will continue at the lower end of the market. And there is profit to be made on the trading side. You're getting nice 5, 6, 7% moves over a week. And it is possible to make good money in those trading ranges.
Rob, very quickly, just looking at the fact that we saw that interest rate cut yesterday, is this reason enough to head into the retailers? We know that they've been pricing in a strong recovery when it comes to the consumer. Do you think that they've been expensive for quite some time? Because that is the sentiment that has been shared generally by most investors.
Yes, obviously they're looking very fully priced at the moment, but people have been saying that now for 2 or 3 months, and the retailers keep pushing out. I think a lot of hedge funds have been caught sitting on the short side of that trade and under pressure to move out. So I think there's some short covering coming into those retailers, and with the interest rate cut as well, the credit retailers are really starting to look good. Truworths looking very, very good, and Foschini looking good as well. So I think that there is still a little bit of value, even though you're buying at the top of the range. Definitely wouldn't be selling the retailers. At worst, just holding onto your position.